Developing a trading strategy. Any experienced trader will say a CFD trading strategy should include 1. Entry criteria, 2. Trade time frame, 3. Money management, 4. Risk control, 5. Stop loss planning, and of course 6. An exit plot. Now let's just get an overview of these things. Entry. There are so many ways to determine a possible entry point that it is really impossible to mention them all. You can use moving averages, trend lines, chart patterns, candlestick patterns, support/resistance levels, a wealth of technical indicators, and much, much more. Then, when you start to consider using these things together, the different permutations are endless. And that's apart from any fundamental analysis you might care to incorporate. So many people believe that a reliable entry is the only thing that is important, but strangely, this is perhaps one of the least important aspects of a good strategy. You actually can make a profit with considerably less than 50% winning trades, provided the rest of your strategy, including money management, is quite sound. Time frame. You also need to decide if you want to be a buy or hold investor or a short-term trader. Day traders will have time frames in minutes or even seconds. Swing traders will look for short price swings or short trends and will use end-of-day charts for analysis. A trade might last a few days to a few weeks. Now, some traders prefer longer-term positions that last weeks or months. Your trading strategy can dictate your time frame, or you can build a strategy to suit the time frame that you prefer. The time you are able to devote to your trading will also dictate your time frame. Money management and risk control. Essentially, you must look at how much you are prepared to trade with. How much are you prepared to risk on each individual trade and the size of your trades? The objective is to preserve capital if trading does not go well, because once you are out of capital, you simply can't trade anymore. A point worth remembering is that if your maximum risk is a percentage of capital, then if your capital decreases, so will your risk in money terms. Also, if you are opening more than one trade at a time, remember your overall risk across all positions. Stop losses. Perhaps the hardest part of building a trading strategy is knowing where to place your stop loss, and it's always a compromise. Some traders do not use stop losses at all. At my firm, we believe that it is absolutely imperative to utilize stops, or you will have little control over your maximum trade risk. Where to put your stop loss must be an integral part of your strategy, and once you decide, you must stick to it. You see, the danger of not placing a stop is that you are always tempted to let the loss run for a little while longer just to see if it turns around. This is a sure sign that you are now trading on emotion and not with a sound strategy. And this is usually a recipe for disaster because your emotions, fear and greed, are just about the worst traders in the world. More about that later. Exit point. An exit strategy can have several reasons for exit, such as a technical price movement, or bad news, or a profit target being reached. It doesn't have to be just one thing, but you must know all the circumstances where you might want to close a trade. For more information, visit www.contracts-for-difference.com.